When you can actually see your profit for the year in dollars and cents, it gets you more in the notion of selling corn, knowing that I can lock in a $50,000 profit or whatever the profit is. You want to lock it in. If I know I can make that much profit in a year, I will be in business next year.
Good afternoon, welcome to GrainTV. It's October 3rd, 2014. I'm Logan Burgess. To my right here is Cody Bills to discuss a relatively mixed trade for the grains in Chicago. Let's take a look at the iPad here and see where we settled. We had corn down a penny here, soybeans off 12 3/4. We had Chicago wheat showing a little bit of strength, up 3.5 cents there today. Relatively quiet trade day in Chicago. We did get some Informa numbers out, which was one of the big drivers here late in the afternoon. And you can see here the big shock to the trade was the soybean production figure coming out about 100 million bushels above what we got from the USDA in September. The soybean market was hanging in there for quite a bit today, but once these numbers came out, really helped this market move lower, and it closed relatively weak today. It'll be interesting to see how we open up Monday. But as I said, it was a relatively quiet trade on a Friday, so we wanted to take some time here on GrainTV to discuss a question that we've been getting a lot here in the Grain Hedge office, and that question has to do with insurance payouts here, specifically for corn. Right now, a lot of producers are looking at receiving a potential insurance payout, and they want to know how they can protect themselves or protect that payment against an increase in the December corn contract, Cody. And today we wanted to, as I said, kind of break down some tools that you can use if you are looking at that right now.
Yeah, absolutely. Well, let's talk about it. Let's go over the knowns. Let's go over the unknowns. What we do know is that the average February price is $4.62, and when you look at the price that we were trading at when we were putting these slides together, it was around $3.22. That constitutes a 30% decline here in prices. So basically, if you have an actual 2014 yield that's less than 15% above your APH, and you have about an 85% coverage policy, then you're eligible for payments, for insurance payments, if the December futures stay at the current levels and don't rally here. So let's go through an example. You have an APH of 150. In this year's harvest, you're expecting to pull out around 165 bushels per acre. That's a 10% decline in prices. That's a 10% higher yield. That's a 30% decline in prices. So what you're expecting to see is that's a 20% decline in revenue.
Right.
And if you have an 85% coverage policy, you're 5% in the black here.
Right.
So with that being said, Logan, you're 5% in the black. How do you protect that 5% insurance payment if you think this market's going to rally?
Right. Obviously, it's important to note that you have to be bullish this market here during the month of October if you're going to embark on a strategy like this. And the two ways to do that, though, is either buying corn futures or by buying a call on corn futures. And corn futures is not the way that I would go. There's quite a bit more risk involved, and obviously as a corn producer, you're already growing corn out in the field, so by getting long this market, it's really easy to overextend yourself. And for that reason in particular, I'd go with options. When you look at options, you have limited downside risk, and it still enables you to participate in some of the upside, as you said, Cody, if the December contract is able to rally here. So if you take a look at this slide right now, today we looked at some short-dated November call options on the October 24th, or on the December corn contract, and you can see right now a 325 call is going for 5 3/4 cents. 335 is just 2 5/8 cents. And if we run through some different scenarios here as far as what could happen during the month of October, if the market rallies, your insurance payment is going to erode a bit, but that call option is going to increase in value, and you're going to pick up a little bit there, protecting some of that payment that you're expecting here today. Conversely, if the market continues to fall, you're going to continue to see that insurance premium grow, and you're going to see the premium that you paid for those call options go to zero. So that's kind of the downside of the plan. As we said, it's important to keep in mind that this is for somebody who is expecting an insurance payout, and they are bullish December corn futures during the month of October.
Absolutely. Obviously, for producers that expect the price to stay about the same levels, it's not in their best interest to purchase an option. However, if you're concerned that the market's going to rally at one of the, what I would consider kind of one of the worst times for it to rally here is right when when the insurance, the average October price for the December futures, I think it would be the worst case scenario if it gets a little short covering rally here and then returns to lows in November.
Right.
If you're concerned about that sort of a scenario happening, that's where you'd really want to look at the options, look at the different premiums, look at the strike prices, see what's right for you, and kind of gauge it based on your bullishness. You may find a situation where you're able to spend $150 on a call option and you're able to get a nice payment if this thing does go into a short covering rally.
Yeah, absolutely. Well, to kind of wrap that up and change directions here, it is Friday on GrainTV, and we do like to take a look at what we're seeing right now in the cash market. Obviously here, barge rates has been a huge focus of the cash grain market. We've seen an exceptional increase in barge tariffs. As you can see from this chart, this is looking at the Mississippi River, and you can see that now barge rates are sitting around 160 cents per bushel. That compares to about a month ago when things were around 90 cents per bushel. So obviously that big increase has been significantly weighing on basis levels at river terminals. Cody, what are you kind of seeing in particular there?
Absolutely. When you look at corn along the river terminals, we saw an average of, trading down 6 1/8 cents. When you look at soybeans along river terminals, we were trading down 13 1/4 cents. The bottom line here is the increase in barge rates here really as a result of people expecting a significantly larger yielding crop coming out of the fields this year, and that's why we're seeing these barge rates higher, but that's definitely negatively impacting the basis along the rivers.
Yeah, absolutely. If we take a look here at the new crop basis changes that we're seeing, where are we seeing some strength, where are we seeing weaknesses? Obviously right now a lot of producers taking a look at those new crop deliveries.
Well, in some of the southern areas, we are seeing some basis declines. The way that we calculated this is it's kind of interesting because when you look at it from September to October, of course, we were looking at that October bid, but because we only had 2 days, we were looking at it from last Thursday to this Thursday.
Right.
And what we did is we looked at the spot basis off of last Thursday, and we calculated the basis off of the December contract the same way that we would do it today. And I think part of the reason why we saw a significant decline in basis this week is simply because we had a lot of these first half premiums or even these premiums for delivery right now.
Right.
Now we're going into the true new crop where a lot of the grain coming out of the field is no longer meeting some of that old crop demands here. And I think that's why we're continuing to see basis decline here. But just the fact that we're seeing barge rates rise, we're seeing river terminals decline. The bottom line here is that basis is taking a bit of a hit this week. Not nearly as bad as soybeans did last week. It seems that soybeans is finally stabilizing a little bit, only down 7 cents compared to being down over 100 cents last week.
Yeah, I think a lot of the strength that we saw there in the cash soybean market was really reflective of exceptionally tight stocks that obviously the USDA kind of missed the mark on when we got that September 1st grain stock report on Tuesday. If we look here, kind of what we're expecting though over the weekend, you can see that there is a good chance that we're going to see some freezes in parts of Nebraska, South Dakota, North Dakota, and even Northwest Iowa. Obviously we didn't see a lot of buying on the board in Chicago today as a result of these expectations, but this could be the kind of thing that could end up making for an interesting open on Sunday night if we do get a harder freeze than what some people are expecting. If you want to be able to view those live quotes out of Chicago on Sunday night as the grain market opens, you can visit us over at grainhedge.com, and you can take a mobile trading app. It's 14 days, and it gives you the opportunity to get it in your hand and see if it's something that you want to use in the combine or in the field here as we enter harvest. If you have any questions about that, call the office. Number is 877-472-4607. Thanks a lot for joining us here on a Friday. Have a great weekend. We'll see you back here on Monday.